Hey everyone, welcome to this month's Asheville Region Housing Market Update for August 2022. My name is Jason Land and I'm a realtor here in Western North Carolina. If you like this video, be sure to like and subscribe to this channel. I'll be posting housing market updates each month with other informative videos for both buyers and sellers. First, we're going to be talking about the housing market on a national level and why experts are saying that a housing market crash isn't likely this year. Then we'll talk about what experts are predicting will happen for the rest of the year. And then finally, we'll get laser focused on the Asheville region housing market and we'll discuss exactly what's happening here in Western North Carolina. So I'm going to jump right into the first topic and we'll discuss what's happening to the housing market on the national level. Now, I think we can probably all agree that this year has really been defined by rising mortgage rates. And what you're looking at here is the Freddie Mac 30-year fixed rate from January through today. And we can see over time there's a trend of mortgage rates ticking up week after week. We see this peak in the rate right around the mid-June, end of June time, and now we're beginning to see some fluctuation. This isn't to suggest we're out of the woods yet, but we are seeing some signs that mortgage rates might be leveling off and perhaps even dropping. A lot of this has to do with the moves the Federal Reserve is making to ease inflation. You've probably heard me say in other videos that rising inflation will oftentimes lead to rising long-term interest rates. The Federal Reserve is trying to ease inflation by raising the federal funds rate. The consensus is the Federal Reserve is beginning to get a handle on inflation, but as that begins to happen, there's a fear of a recession that comes into the conversation. Whether we're in a recession right now is up for debate, but there's a widely held belief that a recession is 2 quarters of negative growth. And many experts are saying that has already occurred. The real question, however, is how would the housing market be affected by a recession? A recession just means an economic slowdown, and if we look at what the data says, a recession does not mean falling home prices. I've used this visual in some of my other videos, and what it shows is that in 4 of the last 6 recessions, home prices have actually appreciated in value. The key takeaway here is that in 4 out of the past 6 recessions, home values have actually increased. A recession also means falling mortgage rates. As we look at the data about what's happened with mortgage rates over the past 6 recessions, we've seen that in each instance, mortgage rates have declined during recessionary periods. That's really good news if you're a home buyer right now. Next, let's talk about another big question that's on everyone's mind, and that's if we're headed toward a housing market crash. The housing market won't crash, and the key factor here centers around the low housing inventory. Now we know there are 3 places where the housing inventory comes from. It comes from current homeowners who are listing their homes, it comes from new construction, and it also comes from distressed properties, things like short sales and foreclosures. When the housing market crashed in 2008, we had an oversupply of homes on the market, and today we have an undersupply. It was that oversupply of homes in 2008 that ultimately led to the housing market crash. Today it's just the opposite. We don't have enough homes to meet buyer demand. This is a look at existing inventory, and today the total housing inventory registered at the end of June, the latest data that we have, was 1.26 million units, and that nationally, that represents a 3-month supply of inventory. Here in the Asheville region, that number is even lower, with just 2 months supply of inventory reported at the end of July. Now compare that to the red bars you see during the 2007 to 2011 time frame. That's the oversupply that we had during the housing bubble when the housing market crashed. That's because we had more homes on the market than we had buyers to buy them. We have the exact opposite today. And if you look at this comparatively, where we are today is nowhere near the oversupply we had the last time. The typical neutral market, where both the buyer and the seller are on equal footing, that's generally accepted to be 6 to 7 months supply of inventory. We don't even have half of that at this point, meaning we're nowhere near the number of homes coming to market that would lead to a housing market crash. Now, the other place inventory comes from is new construction. This is a look at monthly new residential construction, and I've broken it down into 4 stages of construction. Building permits and housing starts are our leading indicators that tell us where the market is headed. Under construction and housing permits completed are the lagging indicators. We see that permits and housing starts are slowing down from May to June, and that's because builders recognize that mortgage rates are rising, which leads to a softening buyer demand. Builders don't want to overbuild, so they're being cautious on starting any new builds. Now, if you look at the bottom charts, especially the chart showing the number of housing units completed, you can see that 1.3 million homes are targeted for completion this year. This is terrific news because it will add more inventory to the market and it will help really create some options for buyers. But the key takeaway here is that we're not on pace to have an oversupply. Now, the third place inventory comes from is from distressed properties, things like short sales and foreclosures. The reason we won't see a flood of foreclosures is because of the stricter lending standards implemented after the last housing market crash. Back then, we had much looser lending standards, but this graph shows that lenders have tightened up those standards. This chart shows the Mortgage Credit Availability Index, and the higher that green line is, the easier it is to get a loan. In the years leading up to the 2008 housing market crash, it was much easier for someone to get a home loan, even if they couldn't afford it. Ultimately, this led to a tremendous amount of foreclosures. Now you can see that green line really drops off 2008, 2009, and that's when lending standards really tightened, and that's when buyers were required to be much more qualified. So those who are getting home loans today are much more qualified buyers and are more likely to repay their loans and not go into foreclosure. That's a huge difference that we have today. If you couple the new stricter lending requirements, along with the various loan forbearance programs that are available, along with the amount of increased equity homeowners have seen built up in their homes, meaning that they have enough equity to be able to sell their homes, make a move, and avoid the foreclosure process, we see that homeowners today have different options that they didn't have in 2008. And these are huge reasons why we won't see a wave of foreclosures coming to the market. Now that we've talked about three areas where housing inventory comes from, even if we have homes coming from all three of those areas, the month supply of inventory still shows that we're solidly in a strong seller's market. And even though we've seen a slight uptick in where inventory is today, which is great news for the housing market, it's still nowhere near the amount of inventory that was seen in the 2008 to 2010 timeframe, when we truly had an oversupply of homes in the market, and that led to the housing market crash. So we've talked a lot about where the housing market is today and why there's not likely to be a crash, but I think the big question on everyone's mind is what's ahead for the rest of 2022? We've already discussed how mortgage rates have been rising since the beginning of the year, and I think a lot of people are wondering, where are mortgage rates projected to go? This chart is a look at mortgage rate projections from Freddie Mac, Fannie Mae, the Mortgage Brokers Association, and the National Association of Realtors. Across the board, the experts say that rates are projected to remain steady at about where they are right now through the third quarter of 2023. So that's great news for home buyers who might have been priced out of the market or pressed pause on their plans to purchase a home due to the rising mortgage rates. Another question on everyone's mind is where are home prices headed? Well, if you look at what the experts are saying, this is the home price forecast for 2022. This chart represents 7 key industry leaders and their take on home pricing. And if you look at them and average them all together, the average of all 7 is showing a 10.3% home price appreciation through the end of this year. While that's a lower gain than the 15% appreciation we saw last year, the key takeaway here is that homes will continue to appreciate in value. So what does this all mean? Well, this is a great visual to look at. We're seeing fewer multiple offer scenarios. So you can see in April, nationwide, the average home sold had 5.5 offers. That number dropped down to 4.2 in May and to 3.4 in June. That is a trend that we're seeing going forward. We're also seeing fewer homes selling above asking price. You can see that the percentage has ticked down from 61% to 51%. But don't misunderstand, we're still in a very competitive market if 51% of homes are selling over asking. You can see that the month supply of inventory is ticking up as more homes are coming to the market. All of these factors mean that home buyers are beginning to see a little bit of loosening in the market. Now let's take a look at what's going on in the housing market right here in the Asheville region. From an inventory perspective, the number of homes for sale remains low at just 2,184 homes. That represents just about 2 months of inventory, and you'll remember back from our previous discussion that a balanced market is considered to have 6 to 7 months of inventory supply. This means we still have a strong seller's market here in the Asheville region. That said, the month supply does appear to be trending upward from the first quarter and from June's 1.7 months supply. The reduced inventory still means homes are not spending much time on market with an average of just 24 days. However, this is a few more days on market than what we were seeing in June when the average was 21 days on market. Because inventory remains low and buyer demand is still high, the average list price is still hovering around $533,000, with the average sales price right around $480,000. While the market is in a shift, experts still predict home price appreciation at around 10% this year. So if you're a buyer, I wouldn't expect either the average list or the average sales price to drop in the foreseeable future. One change we do see from the June market report is the percent of list price received from buyers. Unlike the June numbers where we saw sellers receiving on average more than the asking price, we're now seeing sellers receive just under the list price at about 98.2% of the asking price. This is simply the market shifting a bit due to interest rate fears. However, I don't expect this trend to continue. Sellers are making their pricing adjustments now, which in turn will cause many buyers to re-enter the market. This in turn will sustain the high levels of demand that we've been seeing. So let's recap. What does all of this mean? Mortgage rates appear to be stabilizing and inventory remains at historic lows, meaning buyers still face tough competition from one another. The good news is we're starting to see a small uptick in the number of homes available here in the Asheville region. And with experts predicting another 10% home price appreciation this year, now might be the perfect opportunity to jump back into the market if you've been sitting on the sidelines. As a home seller, you know that buyers are still competing with one another. The recent stabilization of mortgage rates means that those buyers who might have become skittish in the early spring when those mortgage rates began ticking upward may now be re-entering the market, providing additional competition for your home. Experts are predicting that home values will continue to appreciate throughout the remainder of the year. Now, perhaps not at the historic levels that we've seen in the previous 2 years. Rest assured, home values are certainly not on the decline. Whether you're a home buyer or a home seller, if you have more questions about the housing market or would like to discuss my strategies for buying and selling homes in this ever-changing landscape, give me a call. And if you like this video, please be sure to like and subscribe to my YouTube channel, where I'm always uploading new video content for home buyers and sellers. Thanks everyone for watching.